Hello, hi. My name is Nick Burgess. I'm a quant analyst. I work in financial markets and I specialize in interest rates. And today I'm going to talk to you about swaps. So, why are swaps important? Well, swaps are important because when governments, corporations, and individuals, when we borrow money, swaps are pretty much embedded in all of our loans and we're being charged for them. So, I think we should know about that. Now, what is a swap? Now, a swap is a transaction whereby you get to exchange floating interest for fixed interest. Now, why do we care about that? So, generally, when we borrow money from the bank, money by default is charged at a variable rate of interest. And that means over time, you may borrow money today for 4%, but tomorrow you might be paying 5%, you could be paying 6%. And can you afford that? What happens if the rates increase even further and you're paying 10%? And so a lot of people are uncomfortable with the idea of paying floating rates of interest, especially over long periods of time, like in your mortgage. You don't know where rates are going to be and what we can afford. So we use swaps to fix the rates and exchange fixed cash flows for floating cash flows. And it's very important because we're being charged for that in our loans whenever we switch from the default mechanism of variable rate interest rates to fixed interest rates. So that's what swaps are. And that's why we do them. So let's talk a little bit about the swap transaction itself, what the banks are doing behind the scenes, how that works, how they're priced, and we'll look at the potential uh, costs. Now, interest rate swaps, they have two legs. Each leg is representing a set of cash flows. So we have a fixed set of cash flows and a float set of cash flows. And what you can see in front of us is a Bloomberg screen where the swaps are being transacted with that between banks. So the fixed leg here is on the left, and you can sort of see here it's a dollar swap. So in this case, we're just going to receive cash flows that are based on $10 million, and these are cash flows over a 5-year period, and we're paying 4.1626% interest. We'll call that 4%. We're paying 4% interest on one side, and we're paying annual. Now, swaps can be customized. You don't have to pay annual coupons. Most people are paying monthly interest, so you might see monthly for retail investors, but it's quite common to see annual for corporations. So we've got a fixed leg here where we're paying 4% on $10 million. So that's the loan amount. And in this case, we're going to receive fixed and we're going to pay floating interest. And again, the floating interest is on $10 million. It's for 5 years. It's on a variable rate called the SOFR rate in the US. And we're going to be paying annual interest. So in terms of specifying the transaction, we typically specify the amount and the notional, the cash amount that we're potentially borrowing, that our cash flows are based upon. You specify the maturity, which in this case is 5 years, and an interest rate of 4%. And obviously, you specify how often you pay your interest. And that's on both legs, fixed and float. Now, to be able to price and evaluate what those cash flows are worth, we need some market data, and we need a model called an interest rate curve or a yield curve, an interest rate model. And that model gives us two things. It gives us an estimate of what we think forward interest rates are going to be, the forward rates, and it also gives us another thing called the discount factors. And the discount factors are what allow us to sort of take cash flows that are in the future and work out what their values are in today's terms. So that's the market data we need to price this transaction. And what you can see in terms of pricing, how are swaps priced? Now, this is quite interesting. On day one, on the very first day of a swap trade, the swap is worthless, and it's actually got value, but it's offsetting. And so, what banks are doing when they sort of trade swaps is they trade swaps by specifying what's called a par coupon. And the par coupon is the fixed rate that makes all the fixed cash flows equal to all the floating cash flows. And therefore, when you add everything up, it has no value. Now, on the first day, swaps are designed to be fair. So what you're paying, what the fixed cash flows are being paid, have the same value as the floating cash flows being received, so that everything is fair on day one. And then as interest rates sort of move around over time, the variable rates, as those change, someone will be making money, someone will be losing money in terms of the swap transaction. And then obviously, if you're sort of halfway through a swap and you decide you don't want it anymore, then you can obviously sell that swap, but you won't be quoting the par rate anymore because you'll be quoting what's called a present value. There'll be a cash value of that swap, and you'll have to settle the that difference. And that's all been done behind the scenes. The banks will be taking care of that for you, and they'll be embedding that some of these fees for these transactions into our loans. So what do we see here? We can sort of see that the fixed rate, we're receiving 4%, and we're going to be paying floating rates. And we're expecting in this case that we're going to be receiving $1.875 million. We're going to be paying $1.813 million. We can pay a bit less, and so the bank on this swap is probably going to benefit by $62,000, 170 62,170.79, which is what you see here at the bottom. Now, so this is the cash value of this swap right now. It has this value, and we can see here the par coupon. That's the fixed rate that would make this swap, which would make both legs, make all the fixed cash flows match the floating cash flows. That's quite an important number to be aware of, the par coupon. Um, so we've talked a little bit about why what swaps are, why we trade them, and we talked a little bit about pricing them. And so, just to summarize, swaps are embedded in all of our loans. Whenever we want to exchange floating cash flows, which are the default variable interest, we would swap that for fixed interest. Behind the scenes, your banks will be entering into a swap, and there'll be interest rate models, they'll be working at the cash flows, they'll be working at the valuations, and they'll be obviously charging you those transaction costs as part of your loan. So hope you found that useful, and thank you for your time.